Welcome back. In your consumer news this week, the Federal Reserve raised interest rates for the second time in less than 3 months, leaving many people worried about the impact on our wallets. Local financial professional Jon Lawton from Open Air Advisors is here to really share what the latest interest rate hike is and what it means for consumers. Good morning to you.
Good morning, Cleo. How are you?
I'm doing well. All right, let's talk about this hike and how much of an increase did the Federal Reserve make?
Okay, so on Wednesday, the Federal Reserve raised interest rates 0.5%. We haven't seen an interest rate increase like that in about 22 years.
Wow.
But we would say they're still behind on raising interest rates. We would expect another 3 interest rate increases, all with the goal of getting that Fed target funds rate to about 2.5% by year end.
Uh-oh. Now, why is the Federal Reserve raising the interest rates?
Inflation. I mean, short answer is simply inflation. The Federal Reserve has 2 mandates. The first one is to curb inflation at a target rate somewhere around 2%. Currently, that rate is 8.5%. So they have to do something to bring that inflationary rate down. The last is full employment. And currently we have 5 million more job seekers than we do open positions.
Right.
So that gives them a full license to basically to raise interest rates.
All right, the big question this morning, what kind of impact will the increase have on our wallets?
Sure. And even though there's no direct link to the federal funds rate and our wallets, we do see it come up in several different places. And the first, as far as interest rates go, there's 2 sides to that coin. And the first one is our borrowing costs. So you were talking earlier about credit cards and the rising, folks spending more and more on credit cards. Expect to see those interest rates increase on those. If you're carrying a balance on your credit card, expect to see those interest rates increase. The good news is those folks who pay off their credit card at the end of every month, you shouldn't see any change in costs associated with your card. If you do see those 0% offers in the mail, those may be drying up soon. So let's take advantage of those.
Yeah.
Also, mortgage rates. Cleo, have you seen mortgage rates here recently?
They're going up.
They're going up. Since December, we've seen a 2% increase. On Wednesday, it was over 5.55%. So a really big change in the cost of home ownership through the mortgages that you pay. But the other side of that coin, and one of the parts that's interesting is your savings rate. And so one of the things I would just say to anybody out there looking for savings, as far as a savings account or CDs out there at the bank, most of the big banks have not raised interest rates on their savings account. In fact, as of Thursday, the average savings rate was still 0.06%. So anybody that's out there, shop around, talk to a professional. Interest rates are going up, and you should take advantage of that when you can. Unfortunately, you're not seeing that in a lot of places where you should.
Jon, I mean, you're the expert here for people that are looking to maybe buy a new car, buy a home right now. Would you say do it now because it could go up even more, or hold off? Let's see what happens.
Well, like we said, we're expecting 3 more interest rate increases by the end of the year. And really the last effect, Cleo, and one that I think is probably, right now with the market, I think that's probably one of the things that we see the most, or what I'm getting calls on day in and day out. The S&P 500, we raised interest rates on Wednesday. On Thursday, the NASDAQ was down 5%. The Dow was down 1,000 points. And so we've seen a lot of volatility in the market. But where that's hurt most is in our fixed income. And so talk to a professional, talk to a fiduciary advisor, and make sure that you have a plan for risk management.
All right. Jon Lawton from Open Air Advisors. Thank you so much for joining us this morning. Great insight.
Thank you.
All right.